What's good, everyone? So in today's video, I'm going to be showing you and explaining you why structure and liquidity is the absolute easiest way to get rich in trading. And it truly is, because you have to think of it like this, right? What makes the market move, right? What moves the market? That's structure and liquidity. So if you just learn that and if you just master that, you will become successful within trading and you'll become rich, right? But obviously, there's a lot of factors that go into play with this, on how to do it, where to do it, when to do it, all that good stuff. But I'm going to be going over everything about it in this video, right? If you just delete this for a second here, I'll also be going over a presentation about how to do it, when to do it, where to do it, how to put it all together, all that good stuff. And I'll also be going over live trading examples as well. So everything is covered in this video, right? And without further ado, take some notes and let's get into it. So first of all, before we get into this, do yourself a favor here. Watch this entire video until the end, because if you can't watch this, learn this, master this, and implement this, you simply can't become profitable and successful with trading. And that's just the harsh truth here. But anyways, let's get into it, right? So first of all, this is the theoretical way of market structure, aka price action, aka structure. It's all the same thing, right? Bullish example, bearish example, right? So everyone has been taught this way to trade, including myself, and you have probably been taught that as well, right? You simply just wait for a breakout of a significant level, right? Price breaks out right here. Wait for a retracement to that level. Wait for a rejection at that level. Entry, stop loss, take profit at new higher highs. So simple, right? So simple. We'll get into this as well, right? Bearish example, breakout of a significant level right here, right? Retracement to that level, rejection at that level, entry, stop loss, take profit at new lower lows. So simple. But there's a problem here. If price was this easy to read, everyone would be a millionaire, everyone would be successful, everyone would become profitable, right? But the problem is that 99% of traders are trading this exact way right here, but 99% of traders are also unprofitable. So you kind of have to do the math here. If 99% of traders are trading this way, and if 99% of the traders aren't successful and aren't profitable, there's something wrong, right? Now, you just have one job here, right? You just don't have to be in the top 99% of traders, but being the top 1% of traders, right? But what does the top 1% of traders do compared, differently compared to the top 99% of traders? Well, the top 1% of traders wait for these, top 99% of traders to get liquidated, and then they take advantage of that move post liquidity grab, right? So it does something like this, right? Now, as I said, this is the theoretical way of price moving, right? Market structure, price action, so simple, right? High, high, low, higher, high, right? Low, lower, low, no, lower, high, my bad, lower, low, right? But market doesn't move like this. Market doesn't move like this, okay? Get that into your head. Price needs liquidity in order to move, right? It's like a rubber band, to be honest. In order for price to go up, we need to go down first. And in order for price to go down, we need to go up first. In order for price to move up, we need to shoot down first, grab liquidity, and then boom, with all that momentum, with the liquidity grab, with the market open, so a London open, New York open, or something like that, right? And with that liquidity, we shoot directly up. So as I said, needs to go down first in order to come up, right? Vice versa. If we need to go down, we need to push up first, grab orders, grab liquidity, grab stop losses, grab money, and then boom, we get that big move post liquidity grab. And that's what we want to take advantage of. That's how you be. That's basically how you, to be in the top 1% instead of in the top 99% of traders. Now, there's a lot of factors to this, and I'll cover this as well. So first of all, let's start here. As I said, it is the theoretical way of trading, right? So don't do that. Don't do what 99% of traders are doing, because 99% of traders are unprofitable. Now, the fundamentals here, let's just go over that, right? First of all, what is liquidity, right? Liquidity equals stop losses equals money, and money equals liquidity. Now, whenever you make money as a retail trader, the market loses money. Whenever, the market wins, you lose money, right? So you have to get that into your head. So if the market is just going to shoot directly up when everyone gets in buys right here, right? The market loses money whenever you make money, whenever you hit your take profit up here. But is it going to do that then? No, obviously not. It's going to shoot down, stop out everyone that had their stop loss down here, and then it's going to move, right? Because whenever you lose money, the market makes money, right? And liquidity equals stop losses, and stop losses equals money from retail traders and institutions, right? Now, second of all, what is a liquidity grab? Now, a liquidity grab, as I said, is just a break of previous highs or lows, to grab orders, to grab stop losses, to grab money, and then it's going to shoot directly up with that volume, with that liquidity to go up. In order for price to go up, we need to go down first, right? Boom, boom, right? We get that move directly up. In order for price to go down, we need to go up first, right? We need to grab liquidity, grab orders, grab stop loss, and then boom, we go down, right? That's just simply how it works, right? In order for price to move, we need liquidity, okay? Now, when does the liquidity grab happen, right? Third question here. Well, it typically happens at a market open. So at London Open, New York Open, or NYC Open. And it typically aligns with this as well. I'll get into it, right? So we typically start to consolidate, move sideways, pre-market open, and then in market open, we shoot down for a liquidity grab. Then post-market open, we shoot directly up, right? As I said, we need to go down in order to go up and vice versa, right? Now, how do we combine liquidity grabs with market structure? Well, that's a good question. So let's get into it, right? So let's delete all these arrows here and let's go to the presentation I have ready for you guys, right? So first of all, structure and liquidity, there's 3 phases in trading, okay? 3 phases. There's the continuation, the first C, consolidation, the second C, and then there's the liquidity, okay? 3 phases. The market can only be in one of these three phases at a time. And it repeats itself. And when something is repeatable, you can make a lot of money trading it, right? So CCL, continuation, consolidation, liquidity. What comes after the liquidity? We start repeating itself. It's just a cycle. CCL, CCL, continuation, consolidation, liquidity, continuation, consolidation, liquidity, and just kind of goes forever, basically, right? Now, as I said, this looks kind of like the previous example we just had on the chart, right? With a, let's draw this in pink right here with a high or low, right? Everyone gets in buys right there after rejection of the significant level right here, right? Everyone gets in buys right there, stop loss down here, take profit up here. What happens is the market just going to shoot directly up. Everyone makes money. The market loses money. No, it's obviously not going to do that. It's going to push down, liquidate everyone. So this becomes a liquidity grab and then stops out everyone. As I said, liquidity equals stop losses equals money. So everyone has gotten out, market makes money, and then it's going to shoot directly up post liquidity grab. As I said, it's exactly like the rubber band. Shoot down, grab orders, grab liquidity, stop out everyone, manipulate everyone, liquidate everyone, and then boom, we get that big move post liquidity grab, and vice versa. In a bearish example, right? Low, lower high, and price starts rejecting this significant level right here. So everyone gets into sells right there, stop loss up here, take profit down here. What happens is the market going to shoot directly down? No, it's obviously not. You're going to shoot up, grab liquidity above these, sell side buy side liquidity above previous highs. So stop losses equals money, money equals liquidity. It's going to grab these liquidity, and then it's going to shoot directly down. That's how price moves, right? It doesn't move like this, high, low, high. And I said rejects this level, because if it was this easy, everyone would be a millionaire. That's just the harsh truth. Price is not going to do something like this. Price is going to shoot up, trigger everyone into thinking that, okay, well, this is going to shoot directly up, right? So everyone takes a buy, stop loss here, take profit up here. Price is going to then shoot down, stop out everyone, and then going to shoot up post liquidity grab. And that's what we want to take advantage of here. Now, with that being said, let's go into the second slide here. So first of all, there's 3 steps to this, okay? As I said, also 3 phases. So the first step is to identify the overall direction. That is the continuation, okay? Now, the continuation is just the first big push, right? That's just the first big push. And as I said, here is a bullish example and a bearish example over here, right? So you can clearly see that it's a bullish overall, higher time frame trend. It's basic. You should know this by now, right? Now, with the high, and then we go into second slide right here, the consolidation, right? Whenever price is consolidating, it just means that it's moving sideways. And this typically happens pre-market open, right? And whenever price is moving sideways, it's generating buy-side liquidity above previous highs and sell-side liquidity below previous lows, right? And there's 2 forms of liquidity, above or below previous highs and lows, and equal highs and equal lows, right? In this case, there's equal highs up here above previous highs, right? So there's buy side liquidity, liquidity equals stop losses equals money, right? So there's stop losses up here, vice versa. On the other side, right? Whenever price moves sideways, it's just doing something like this, right? It's just ranging, right? Now, as I said, there's generating buy side and sell side liquidity. Liquidity equals stop losses equals money. So there's also money down here, right? Liquidity down there. And now we come into the third phase, right? The third step, right? Wait for the liquidity grab and then take advantage of it, right? So the liquidity grab is most likely also always going to follow the overall direction. Obviously, this is bullish right here. This is bearish, right? So in a bullish example, we would see something like this, right? Rejection after this significant level right here, right? Everyone enters, stop loss down here. When there's stop losses down here, there's liquidity down there, there's money down there, right? So price is going to move down. And as I said, in order for price to go down, we need to go up first and vice versa. In order for price to go up first, we need to go down, grab liquidity, grab orders, and then boom, right? So after we've done that, we just shoot directly up post liquidity grab, right? Vice versa. We push down here, low, lower high, right? Everyone gets in sells right here, stop loss up here. When there's stop losses up here, there's money up there, there's liquidity up there. Price is going to hunt that money right there, liquidity grab, and then boom. In order for price to go down, we need to go up first. As I said, let's go this rubber band right here. In order for price to go down, we need to go up first. And then with all that momentum, we're going to shoot directly down, right? Okay, I hope that makes sense, right? So let's get into some live trading examples of me using this, of me I make over consistently now at this point over 10 to 15, sometimes even I hit a 20K month once this year so far, and it's currently April. But yeah, we'll get into that. We'll get into a live trading example. So let's go over there and let me show you how it's done in real time. All right, let me find this live trading right here. Right there. Let's open up. Can I draw on this? Yeah, I can. Perfect. Okay, well, then let's listen to myself here.
NYC is opening up right now as we speak, and shit, there is a ton of fucking volume.
Yeah, so there's a ton of volume, right? As I said, it is market open. It is NYC, so 9:30 a.m. Eastern, right? And as you can see right here, price moves sideways pre-market open. So it also aligns with market open. So I'm anticipating a liquidity gap. If we start flipping bearish, I even think I'd say this in the video. Let's fast forward a bit. Let's listen to myself here.
So I essentially just want this 4 hour to end up flipping bearish, and with that liquidity grab to the upside, liquidating these highs and these highs, right? That becomes a liquidity grab, and we can then take advantage of the move going down.
Yeah, so you heard me right there. I am pre-playing the analysis before it even happens, right? So as I said, I can already see this because I've got good experience with it, but this is the first step, identify the overall trend, which is bearish. Second step, identify the consolidation where price is moving sideways, generating buy-side liquidity and sell-side liquidity. Step number 3 is to anticipate and wait for the liquidity grab, right? And then, take advantage of that move post liquidity grab. The liquidity grab also typically follows the daily direction in this case as well. If we want to go down, we need to go up first, right? Right, as said, rubber band, you get the idea, right? But anyways, let's see here. Let's actually delete these arrows and let's play fast forward here. So I place my sell stops and break of the current 30-minute low, and let's see here, I get activated right there. And can you see this, by the way, right? This is the first C, right? Continuation, right? Can you see this? Yeah, you can see this. Okay, perfect. Continuation, right? Then we get that consolidation where price is moving sideways, generating buy-side liquidity, sell-side liquidity. And you may ask, why is it generating buy-side liquidity, or how does it work? Well, simply because there's retail traders that saw this push right here. And after this candle right here, right, you see this bearish candle, after that rejected this significant level, right? So a breakout, right? Breakout, retracement, rejection at that level, everyone placed their entry right there, stop loss up here, and take profit down here. And because they're anticipating this move to continue down. Well, if that means that there's liquidity, or if that means that there's stop loss up there, that means that there's liquidity up there, right? And when there's liquidity up there, there's money up there. Now, is price going to shoot directly down like this and everyone makes money? All the retail traders, all the institutions makes money, and the market loses money? No, it's obviously not going to do that. It's going to align with market open to shoot directly up first, liquidate everyone here, stop hunt everyone, and manipulate everyone. So they get triggered, right? Their stop losses get triggered. And then with that liquidity grab, we can take advantage of the move post liquidity grab. So if we were to go into the 3 phases again, first of all, continuation. Second of all, consolidation. Third of all, liquidity, right? And then CCL, so continuation, consolidation, liquidity, starts repeating itself. After a liquidity grab, we get that continuation post liquidity grab. As I said, rubber band theory, right? In order for price to go down, we need to go up first. We need to grab orders, grab liquidity, grab stop hunt everyone out, and then boom, with that volume from the liquidity grab from market open, we can shoot directly down. And that's what I'm anticipating here. That's basically how the entire thing works, right? Now let's play this fast forward here. I get activated right there, right? No drawdown whatsoever because there's so much volume. Let's actually mute myself now. From the liquid grab, from the market open, and I basically end up winning the trade. This has a 82 to 83% win rate, by the way. So it's very good. And let's see here, close down, or push down. Basically just close the position there, 2.4K in 2 trades in 2 days, right? Beautiful, not 2 days, but in a week. So 2.4K in a week, beautiful. Let's go over another. But I just want to clarify this, right? First phase, C. Second phase, C. Third phase, L, not C. CCC, no, CCL. CCL starts repeating itself. So continuation, consolidation, liquidity. After the liquidity, we get that continuation, right? Beautiful, okay? Textbook play. Let's get into another one here. Let's get into a bullish example. I think this is bullish. Yeah, okay, perfect, right? Do you see it again, right? First of all, identify the overall trend, which is obviously bullish right here. Do you see this? Second of all, this happened at pre-market open, so we already grabbed liquidity. So overall trend bullish. We move sideways right here, aka there are stop losses down here, there are stop losses here, Here, right, what did price do? Well, we shut directly down. As I said, in order for price to go up, we need to go down first. We grabbed liquidity, grabbed orders, and boom, with that volume, with that liquidity, volume from market open, all that good stuff, we will most likely shoot directly up, right? And that's basically what I'm anticipating here. So I take buys on the break of the previous, right? And you know, basically just win the trade and make a few $1,000s or whatever, right? Let's see here. How much did I make here? Let's see. Let's actually,
Boys, I'm just closing right
yeah,
there.
like 1.1k or something, just under 1.1k. But whatever. Let's get into another live trading example right here. It happens over and over again, and when something is repeatable, as I said,
What's good, boys?
wait,
So
let's mute
in
myself. When something is repeatable, as I said, you can make a lot of money, right? CCL is repeatable, continuation, consolidation, liquidity, right? And then repeats itself, right? But anyways, let's get into this as well. What happens here? Well, basically, you can kind of see it as well, right? So this is on the 1 hour time frame. And right here, the overall trend is bearish, right? You can basically better see it over here because of my webcam. Overall trend, bearish, right? Price moves sideways right here, generating buy side liquidity, sell side liquidity. Liquidity equals stop losses equals money. Do you see how I marked this red line perfectly before we even did this? Look at this. This is obviously during the trade, but before market even opened, I marked this red line over here because it's at a previous high. Previous high means that there's stop losses up there, right? There's two forms of liquidity, above or below previous highs or lows, and equal highs and equal lows, right? And as I said, we simply shoot up at market open right there, activate me because the overall trend is bearish. First, I'm not bullish, bearish, right? Second stage, identify, consolidation, price moving sideways, generating buy side liquidity, sell side liquidity. We shoot directly up, liquidity grab, take advantage of that liquidity grab, post, take advantage of that continuation, post liquidity grab. So if you were to draw it in circles, continuation, right? Consolidation. This video is going to be long here. I hope you guys are still watching, right? But it's valuable. It's very, very valuable. Right? Keep watching here. Liquidity grab, right? CCL. Post liquidity grab, we get that continuation, right? Repeatable cycle. Continuation, consolidation, liquidity, right? And then continuation after liquidity starts repeating itself over and over again. Here I made, I can't even remember. I think I made like 2,000 or something. Let's see here. Made let's see here. Oh, I went out for a piss right there. But let's fast forward this a bit. Yeah, I made $2,100 right there. 5.6k in what? Yeah, 2 weeks. $5,600. This was like 4 months ago, recorded like 4 months ago. Now I make, consistently 10, 12k weeks, sometimes 12k months. Depends on how market conditions. But whatever, the P&L is completely irrelevant here. I just want to show you how it's done, right? And obviously you can see proof of live account above my head. This is not a demo account. I don't flex. I don't even trade demo, right? I'm not a typical trading guru that flexes his Rolex. I don't even have a Rolex, right? Flexes his Rolex or Lambo in Dubai or whatever, like rental cars or whatever. I'm not those demo gurus, okay? I'm here to teach you how to trade and how to do it and how to become profitable with it so you can do it as well, and how I basically got there, right? I'm sharing everything I know about everything about trading, right, on YouTube completely for free here, and I've got some free PDF files as well. I'll go with this in a few seconds or in a few minutes here, my bad. But let's see the next one. Let's take this as a the last example right here, right? So as I said, again, look at this. The overall trend is obviously bearish. Look at this, right? Then price rejects this level right here, right? Or I mean, retraces to this level. So low, lower high, starts retracing, right? Everyone gets it. Sells right there. Stop loss up here. And when there's stop losses up there, stop losses up here, right? Price is going to hunt that liquidity, right? And then after hunt that liquidity, right? So CCL, liquidity, post liquidity, we get that continuation. That's what I'm anticipating, right? Let's play fast. Let's play price right here, activates, and basically make like $1,000 again, right? It's so simple, right? But it happens over and over again. And when I say something is repeatable, you can make a lot of money of it, or basically by taking advantage of it. And that is literally, that's the live trading examples. Now, I want to show you something very quick here, okay? Now, this is literally the entire strategy, the entire structure and liquidity on paper, PDF file, completely for free, 16 pages. Look at this, right? So I push up first, continuation, consolidation, price moving sideways, liquidity, continuation, post liquidity web. Everything is in here, okay? 16 pages of PDF file. You can download this for free. You can also download my entry checklist, okay? I've got all this for free for you. And if you want a mentorship by me, by going over your problems, your situation, what you need to work on, what you're doing good, so we can double down on that, and what you need to fix step by step, one-on-one, personalized. Everything is personalized to your, situation, your problems. Well, you can also go over that, check the links in the description. Everything is in the description. And yeah, I mean, if you like the video And if you found it helpful, leave a like, comment, subscribe. It means the world to me, and I can then see if you like the video or not, and I'll keep making more of them if you did, right? So leave a like, comment, subscribe. Go to the description to figure out or to find these free PDFs and all that good stuff. And yeah, I will see you guys in the next one. Thank you for watching. Peace.